See, the vision of Samco is to, number one, deliver what really investor wants. And we hired a typical FMCG research agency, and the outcome of that research agency was they do research for, they have never done research for in financial services industry. And therefore, that unique insight that we got from that research agency was investors want high return, but at the same time, they also want to stomach lower risk and lower volatility. So if these three things, if we are able to deliver to investors, I think we have, as an AMC, we have. Yeah. So today, when we are building our investment philosophy, we are aiming for, number one, we will give high return to our investors. That is the aim that we have. And also during bad times or during recession, our portfolio will deliver lower risk and lower volatility, because that is what ultimately investors want. So, and our investment philosophy, the Hexashield framework that we have built, will execute that. Number one, in good times, investors will get higher return, and during bad times, recession, the fall in the portfolio will be less compared to what the market falls, and that is how we will be able to give lower risk and lower volatility. The 6 facets of Hexashield framework, briefly, I can describe is growth and reinvestment. So many companies will fail because either they have a low reinvestment rate, or their benchmark return on capital itself is low. So aim for higher return on capital. Number one, 25%. If the companies are generating lower than 25%, we don't want to invest money of our investors, because ultimately that is one key North Star metrics to identify how efficient and how well capitalized the company is in terms of its products, its strategy. So all those companies which have got high return on capital are far superior. And those companies which also reinvest, those are typical compounding machines. And we want to aim for to find those type of companies for our investors' portfolio, so that actually investors' portfolio compound, rather than we only just giving them a generic knowledge that your portfolio will compound. So that's number one. Second, all those companies which have got strong balance sheet, high cash flow generating ability, even in bad times, because good times, everything is great, but during bad times, recessions are also going to come. So that's a time when companies are not able to manage their cash flow, if the balance sheet is weak, if the corporate governance is poor, and if they don't have pricing power. So typically what we look at, those companies which have got pricing power are the ones who will be able to generate high return on capital in good in bad times. And so those are the companies that will pass our filter. And lastly, regulator. Regulator also is a kingmaker. Actually, either it can strangulate the growth, or it can create a healthy environment for the healthy existing companies to grow and prosper. So when all these six parameters the company passes, it passes. And when we do this on Nifty 50, only 15 company passes the stress test, and the results are fantastic. Nifty has delivered 10% CAGR in last 10 years, and these 15 companies have delivered 39% CAGR. So this is how we intend to make portfolio for our investors that grows, that delivers higher value, and during bad times for less. So this is broadly our investment philosophy. And because we have built systems, today we are doing it at a scale and size, and therefore we are scanning 67,000 companies globally, and around 120 company passes our stress test. And these are the companies that we will create portfolio for our investors in all the schemes that we bring in future. So number one, unique features of Samco, our thought process is we need to really work for investors, and therefore whatever is required, we will do, we have done on our investment process, so that I have recently described. So typically benchmarking, our benchmark will be Nifty 500 TRI index, because we have in our Flexi Cap, which will have 25 companies, 9 will be international name, 35%. And 16 companies will be domestic, and that is 65%. So 35-65%, so that we maintain 1 year long-term capital gain tax ratio. So how we are unique, our thought process is we want to deliver best portfolio that investors can earn on this planet. And therefore all those companies across the world who have got high return on capital and high reinvestment rate, this is what we call as a compounding ratio. All those companies which can deliver that are the ones we want to make we want to give as a basket to our investors. And great companies like Microsoft, Facebook, although optically people may think that they are costlier, But when we actually identify those companies, the way we look at companies, I can share this practical example on Facebook. So Facebook had reported net profit of around $29 billion, and therefore it is available at 23p multiple. But how we look at companies, Facebook had also debited $18 billion of R&D expense. Therefore, R&D expense is for future. However, that is not required for the current operations. So therefore, current operations of Facebook are far more efficient. And if we add back $18 billion of R&D, Facebook is available at 15p multiple, which is a far superior business model, high cash flow generating business, great corporate governance, clean balance sheet, high reinvestment. So these are the companies that we want to bring for our investors. And when a large diversified portfolio of 25 companies across the world, when it's there on the platter, I think investor will get a unique, differentiated portfolio, which has got high compounding factor. So high compounding factor, as I explained, high return on capital, high reinvestment rate, and that is the highest at industry level. So currently we have scanned around, there are 1,000 odd schemes listed. We will be at the top of the chart in this compounding ratio. Second, we will also top in the chart of Sharpe and Sortino, because by very nature, stress-tested companies will fall less when the market falls, and therefore when the market rises, the upside will open far higher, and therefore that's how we intend to deliver value to our customers through not only proper focus, proper investment process, but also well-diversified companies across the world, so that investors can get a unique portfolio rather than aggregating so many mutual funds and ultimately the underlying assets are all the same. We want to give him a unique differentiated portfolio through our process. Okay, so typically Flexi Cap for investor, it's like a cap. So our thought process is, let's not get into cap. So Flexi Cap is a go-to category cap. So as such, there is no restriction. But our thought process is, let's find the most efficient and the best company, because that is what investor wants, rather than bracketing ourselves into large cap or small cap. So universe that we will invest in that passes our stress test are the one for our Flexi Cap will be somewhere between mid to large. That category are the ones where we will have a majority of our portfolio. So some of the international names are large, but largely domestic names are in that mid category, somewhere lower than large, but higher than mid. Correct. So sectors that we will not invest are the ones typical no PSU companies, because every 5 years, if my bosses change, I don't have clarity, and we don't want to invest money of our investors, wherein the intention of the owners are either do profit and also social service. So PSU is a no category, no infrastructure fund as a category, no highly leveraged companies as a category, no cyclical. And this is also very clear, no cyclical companies, because typically what will happen is cyclical, all this cement, steel and hotel, if they are making good profits, no, banks will come and finance. These companies are prone to mean reversion. What we mean by mean reversion is, if they are making good profits, no, banks will finance and expansion will happen. And when supply will come in, the realization will fall, because they are price takers from the market. They don't have bargaining power to set the price. And once price, because they don't have bargaining power, all these companies will fall massively when the bad time or recession, or when they do excess supply comes in. And when 50-60% of the prices fall, investors actually don't like, because they don't like higher volatility. Let me explain to you why we will not invest in cyclical. Warren Buffett, sometimes in 2007 September, invested in a company called ConocoPhillips. That's an oil and gas conglomerate. In his time, this much was a billion barrels of oil, and $130 was the price. So in his the value of company was so much and the market cap was so much, there is margin of safety, and he invested. Charlie Munger had said, no, let's not invest, but still he invested. And sometimes in February 2009, when the crude oil was down by $30, he sold and he booked some few $1 billion of losses, and he writes in his newsletter, because my buying price was wrong, I had to sell. And the next line is important, is far more important. What he says is, and they know that crude oil will not remain at that price. The long-term value is much higher, but because their buying price was wrong, they had to sell. Dow was down by 45-50%. ConocoPhillips was down by 60%, and they also sold. So that's the far more important reason, because the risk that if the high volatility is there, the investor might sell. And this is very, very important. And therefore, we want to build our businesses. Our portfolio has to be such, they should not have all the cyclical components or the components which can deliver high volatility. And therefore, all those companies, we will not invest in our portfolio.